If you're searching for ETFs that could provide solid monthly income with high and sustainable dividend yields, then covered call ETFs are worth looking into. And in this video, I'll be breaking down 9 of the best covered call ETFs to invest in that can help you improve or diversify your income portfolio. Quick reminder, this video is for educational purposes only. This is not financial advice, and I'm not a financial advisor. All investments carry risk, so always be sure to do your own research before making any investment decisions. First up, we have tspy, the top alpha SPY growth and daily income ETF. This fund has two main objectives. First is to generate income, and second is to offer growth potential by tracking the performance of the S&P 500 ETF SPY. So tspy holds the ETF SPY directly for S&P 500 exposure, and it generates its income through their covered call strategy by using 0 DTE options. So 0 DTE is 0 days to expiration options, so they expire at the end of the current trading day. This approach maximizes time decay, minimizes extended market exposure, and gives the fund the flexibility to adjust its positions based on current market conditions. And tspy comes with a nice tax benefit since it uses S&P 500 index options, which are classified as Section 1256 contracts by the IRS. This means that 60% of the income is taxed at long-term capital gains rates and 40% short-term. And this is for the income that isn't considered return of capital. For the fees, tspy has an expense ratio of 0.77%, costing you $77 yearly for every $10,000 invested. As for the portfolio, tspy pretty much only holds one thing, and that's the ETF SPY, which in itself has 503 holdings. And the top holdings of SPY include Nvidia, Apple, Microsoft, Amazon, and Meta that make up a little under 40% of the fund. The sectors it's mostly exposed to are going to be technology at the top, then financials, and communication. So some nice diversification that the S&P 500 gives you. On the income side, tspy currently has a dividend yield of 14.4%, and it pays every single month. And if we look at the dividend history over the last year, the payments have been pretty steady, which is great to see. Since tspy was created in August 2024, it doesn't have a long history, but since then it's had total returns, including dividends, of around 26.5%, which isn't too far off from the S&P 500. With the strategy of using 0 DTE options, tspy has managed to provide steady and consistent income in the short time that it's been around. And at the same time, you still have exposure to the diversified portfolio and the historical resilience of the S&P 500 index. So if you're looking for a consistent monthly income fund that tracks the S&P 500 index, then tspy can be one to put on your radar. The second fund on the list is gpiq, the Goldman Sachs NASDAQ 100 Premium Income ETF. gpiq aims to provide income along with the potential for capital appreciation through NASDAQ 100 exposure. It invests in stocks in the NASDAQ 100 index and uses a dynamic option strategy by selling call options on a percentage of the fund's holding, which depends on the current market conditions. And the percentage of the portfolio that they write call options on can vary from 25 up to 75%. The strategy also uses at-the-money call options that are applied on a weekly basis, and it has the same tax benefits from index options. For the cost, gpiq has an expense ratio of 0.29%, costing $29 for every $10,000 invested. For gpiq's portfolio, this ETF currently has 105 holdings, with top holdings in names like Nvidia, Apple, Microsoft, Amazon, Tesla, and more, which nearly make up half of the fund. For the sectors, gpiq is mostly in technology, communication, and consumer discretionary, which this mirrors what you'd see in a standard NASDAQ 100 fund. Getting to the income, gpiq has a dividend yield of 10.3%, which is paid out monthly. The dividend history has been nice and consistent, with very small fluctuations, benefiting from the NASDAQ 100's growth and volatility. gpiq won't let you down in performance, where it's had total returns, including dividends, of over 19.5% in the last year, and annual returns of around 26.5% since it was created in October 2023, about 2.5 years ago. The NASDAQ 100 has had great returns over the years, and the strategy of gpiq allows for the fund to capitalize on more upside potential by riding on less of the portfolio. So it may offer a slightly lower yield compared to some other NASDAQ 100 covered call ETFs, but it provides much more price appreciation. While I believe in the growth potential in the NASDAQ 100 into the future, I think in the short term there will be a bit more volatility. This means higher option premiums and works out for the income side of gpiq, which, if you're looking for NASDAQ 100 exposure with double-digit yields and price appreciation, then take a look into gpiq. Next up, we have iwmi, the NEOS Russell 2000 High Income ETF. This one is different from the others on the list since it's focused on small caps. iwmi invests in stocks from the Russell 2000 index, and it generates high monthly income through a covered call strategy using Russell 2000 index options. And this index is made up of around 2,000 US small cap companies. Like the other funds using index options, which are classified as 1256 contracts, it has the lower 60% long-term and 40% short-term capital gains tax rates. Getting to the fees, this fund has an expense ratio of 0.68%, costing $68 for every $10,000 invested. For the portfolio, iwmi holds the Vanguard Russell 2000 ETF, VTWO, and this ETF contains a total of 1,968 small cap stocks, with top holdings in Bloom Energy, Credo Technology, Kratos Defense, IonQ, and a few others. There aren't any stocks with a large weight, and these top holdings only make up a few percent of the total portfolio. Moving to the sectors, the exposure mostly falls into industrials, healthcare, and financials, with the remaining percentage in a handful of other sectors. Now, iwmi has a dividend yield of 14.2%, which it pays out monthly, and the reason for this great yield is due to the volatility in small caps. The Russell 2000 is more volatile than the S&P 500, for example, and that higher volatility means higher option premiums and more potential income. And looking at the last 12 months of distributions, the income has been pretty consistent, with some small variations over the months, which again is tied to the small cap volatility. iwmi is another somewhat new fund that was created in June 2024, and since then it's had total returns including dividends of nearly 29.5%, which is up there around the returns of some of the NASDAQ 100 covered call funds. The outlook for small caps has been looking better, with possible rate cuts into the future and the solid earnings and cheaper valuations of smaller cap companies. iwmi could be a good way to further diversify an income portfolio by adding small cap exposure, along with increasing your potential for appreciation and higher yields. This next ETF has a different strategy than the others, and that's Divo, the Amplify CWP Enhanced Dividend Income ETF. Rather than tracking a broad index, which has been the theme for the previous ETFs, Divo's managers have a different approach. This ETF focuses on high-quality, large-cap companies from the S&P 500 that have a history of growing their dividends. It also uses a tactical cover call strategy, but only on select individual stocks that are in its portfolio, not the entire index. Management screens stocks for metrics like cash flow, earnings, return on equity, and more. The portfolio stays balanced with a 25% cap on any single sector and individual stock cap of 8%. They also write options on around 20 to 30% of the portfolio, and they target 2 to 3% in annual dividend income from the holdings and about 2 to 4% from option premiums. As for the cost, Divo has an expense ratio of 0.56%, costing $56 per 10K invested. Jumping to the portfolio breakdown of Divo, this fund currently has 28 holdings, with its top holdings in names like RTX, Apple, Goldman Sachs, Microsoft, Home Depot, and more that make up a little less than half of the fund. And the top sectors are in financials, then technology, consumer discretionary, and industrials, so a nice spread with a bit more tilt into the financials. For the dividends, Divo has a dividend yield of 6.2%, which it pays out monthly. Taking a look at the dividend history, the income has been consistent, which is a huge plus. And there was a big spike at the end of the year in the December payout, since the actual income was higher than the estimates that were paid out throughout the year. And Divo doesn't fall short in the performance, with 5-year annual returns including dividends of 13%, and annual returns of just under 13% since it was created around 9 years ago. This is great considering that Divo has a more defensive investing approach. Divo is not as high yielding as the other ETFs on this list, but that's not what it's made for. It's geared towards those investors that are looking for reliable and consistent income, quality companies, and some protection to help avoid downside risk in rough markets. While there is a lot of uncertainty lingering in the air in 2026, if this stays true or the market gets rougher, then Divo will likely shine. Fifth on the list, we have qqqi, the NEOS Nasdaq 100 High Income ETF. qqqi aims to generate high monthly income and provide you with exposure to the NASDAQ 100 index, and invest in NASDAQ 100 stocks and uses an option strategy that includes both purchase and sold NASDAQ 100 index options. And you get those tax benefits of 60% long-term and 40% short-term capital gains tax since it uses those index options. For the fees, qqqi has an expense ratio of 0.68%, costing you $68 for every 10K invested. And the portfolio of qqqi currently has around 106 holdings, with the top holdings in Nvidia, Apple, Microsoft, Walmart, Broadcom, and others. And for the sectors, technology, which is about half, communication, and consumer discretionary, essentially close to the same exact exposure that we saw in gpiq earlier. The best part of qqqi is the income, where it has a dividend yield of almost 14.5%, which is paid out monthly. And the last year of payouts from qqqi have been real solid, which you can see the income has been very stable and only dipped noticeably around the April 2025 tariff sell-off. Since qqqi was created in January 2024, so just about 2 years now, it's had annual returns of around 21%, which is really impressive for the time that it's been around. The Nasdaq 100 has been a high flyer in these past few years thanks to the tech sector. And with the drive in demand for AI and AI infrastructure, there's still some great growth potential ahead. But since this is a tech-leaning fund, that does mean it carries a good amount of risk, because if the tech sector gets hit hard, then qqqi will feel it. While this year may bring some extra volatility, as long as there isn't a huge downturn or recession, I can still see this fund continuing to provide solid income. For investors who believe in the AI theme and the growth potential of the tech sector and Nasdaq 100, but want monthly income, qqqi is a solid option to consider. This next one is about going beyond domestic markets, and that's NIHI, the NEOS MSCI EAFE High Income ETF. NIHI gives you exposure to the MSCI EAFE Investable Market Index, which invests in developed markets that are outside of North America. So it's going to be investing in stocks within the EAFE index and use a covered call strategy with out-of-the-money call options to generate income. It's also going to have the same tax benefits of 1256 contracts like the previous ETFs, since it uses index options. Getting to the cost, NIHI has an expense ratio of 0.68%, costing you $68 per $10,000 invested. And for the portfolio of NIHI, it holds the iShares ETF IEFA, which currently has 2,594 holdings. And the top holdings are names such as ASML, Roche, HSBC, Nestle, and Shell that make up just over 10% of the portfolio. The top sectors this ETF is exposed to are financials, then industrials, and healthcare. And the country exposure includes Japan, the UK, France, Switzerland, Germany, and quite a few more. As for the income, NIHI has a forward dividend yield of 13.3%, which is paid out monthly. And for the income history, NIHI has only been around since September 2025, but since then, the income has fluctuated some, which is going to be tied to the volatility of the underlying index. And moving to the performance, this ETF has had total returns, including dividends, of around 12% since its creation 5 months ago. International stocks really built up some nice momentum in 2025, outperforming the US, and they look on pace to continue doing so in 2026. With strong earnings growth, the weakening of the dollar, and cheaper valuations, all working in the favor of international markets. And NIHI can be a nice option for income investors to get high income, exposure to growth beyond North America, and boost your diversification. Next up is SPYi, the NEOS S&P 500 High Income ETF. SPYi aims to generate high monthly income while also giving you the potential for some capital appreciation through S&P 500 exposure. This fund invests in the S&P 500 and uses a call option strategy that might include both sold and purchased S&P 500 index options. And just like tspy, SPYi uses index options, so you get the same favorable 60% long-term and 40% short-term tax benefits. And it doesn't use 0DTE options like tspy, and instead it writes out-of-the-money call options. For the fees, SPYi has an expense ratio of 0.68%, costing $68 for every $10,000 invested. And for the portfolio, SPYi currently has 511 holdings. And the top holdings are going to look very similar with Nvidia, Apple, the other Mag 7 names, Broadcom, and Berkshire Hathaway, with the sectors mostly in technology, then financials, communication, and consumer discretionary, which is pretty much the same as you'd find with other S&P 500 ETFs. Now for the income, SPYi has a dividend yield that's just shy of 12%, and that's also going to be paid every month. For the last year of dividend payments, the income has been extremely consistent and stable, and this is exactly what you'd hope to see from a monthly dividend fund. The overall market has had some great performance over the years, which is reflected in SPYi, which has had 1-year returns, including dividends, of 15.5%, and annual returns over the last 3 years of 16.8%. And the years are short here since it was created about 3.5 years ago in August 2022. SPY is an ETF that can serve as a core holding when it comes to an income portfolio. You're getting the diversification and proven track record of the S&P 500, along with very stable monthly income that comes with tax benefits. Next up is idivo, the Amplify CWP International Enhanced Dividend Income ETF. You can think of this fund as the international version of divo, which I talked about earlier. idivo invests in large and mid-cap international companies for the MSCI ACWI ex-US index, and it applies a tactical cover call strategy on individual stocks. The portfolio managers screen for quality international companies that they believe will sustain their earnings growth, their cash flows, return on equity, and other metrics. And like divo, there's a 25% sector cap and an 8% individual stock cap. And the fund writes cover calls in a range from 30% to 60% of the portfolio, and they aim to provide an annual income of around 3 to 4% from dividends and 2 to 4% from options premiums. The expense ratio of idivo comes in at 0.66%, costing $66 yearly per $10,000 invested. Moving to the portfolio of idivo, this fund contains 52 holdings in total, and its top holdings are in companies such as Taiwan Semiconductor, Alibaba, Mitsubishi, Barclays, and more, which is about 1/3 of the fund. The sectors this ETF is exposed to are financials, industrials, materials, energy, communication, and more. So a bit lower in its total holdings compared to the index tracking funds, but it does have a pretty diverse spread of sector exposure. And if we look at the exposure to the top countries, it also offers a good level of geographical diversification from Canada, the UK, China, Japan, and many more. For the dividends, idivo has a dividend yield of 4.9%, which it pays out monthly. And jumping to the income history over the past year, you can see it's been fairly stable, which is great, and even slightly increasing some over time. Like I mentioned earlier, international stocks have been picking up steam, and idivo has been bringing the heat. Over the last year, idivo has had total returns of nearly 43%, which is pretty crazy, and it's had annual returns of over 23.5%, since it was created about 3.5 years ago in September 2022. With international stocks looking to continue on a strong pace upward, I think the future, especially the near term, looks positive for idivo. And for those investors that are looking to expand their exposure to international markets while still receiving some decent monthly income and a history of solid growth, then idivo is one to take a deeper look into. Moving on, we have gpix, the Goldman Sachs S&P 500 Core Premium Income ETF. gpix's objective is to provide monthly income along with the potential for capital appreciation. It invests in the S&P 500 and uses a dynamic options strategy of selling call options on a percentage of the holdings in the fund, which are based on market conditions, so the same concept as gpiq. And gpix writes call options on a range of 25% to 75% of the portfolio, and it uses at-the-money call options weekly. And like many of the others, it also has the tax advantages of 1256 contracts when it comes to index options. For the fees, gpix has an expense ratio of 0.29%, costing $29 for every $10,000 invested. For gpix's portfolio, this ETF currently has 500 holdings, with top holdings in names like Nvidia, Apple, Microsoft, Berkshire Hathaway, and more, which make up over 1/3 of the ETF. For the sector exposure, there's technology on top, then financials, consumer discretionary, healthcare, and a handful of others. So it's pretty diverse in its holdings and sectors, which is very similar to a regular S&P 500 fund. Getting to the dividends, gpix has a dividend yield of 8%, which is paid out monthly. Taking a look at the distributions over the past year, the monthly income has ranged from 34 to 38 cents a share, so it's been very consistent and stable. As for the performance, gpix has had total returns, including dividends, of over 16.5% in the last year and annual returns of around 23.5% since it was created in October 2023, about 2.5 years ago. gpix is a nice, well-rounded option for those investors who want S&P 500 exposure and consistent monthly income without having to sacrifice too much growth potential. It makes for a solid option to consider with great yield, stable monthly income, great appreciation, and its diversification to the S&P 500. And when it comes to monthly dividend ETFs, one of the top ETF issuers is NEOS, and in this video here, I go into the best NEOS most ETFs for consistent, stable, and high monthly income. And if you got some value from this video, please be sure to hit the like button and subscribe for more content. Keep on investing, and I'll be seeing you on the next one.